1. Start with energy. Explain with authority. Highlight with emphasis. End with warmth. As of the market close on Wednesday, November 26, 2025, SoFi Technologies, Inc. is trading at exactly $28.49. We saw a positive push in the last active session, with the stock climbing 16 cents to lock in a 0.56% gain. In the after-hours market, that momentum is quietly continuing, ticking up another 5 cents to $28.54. Now, if you are just glancing at your Fidelity mobile app or checking the headlines on Robinhood, you might see a stock hovering near $30 and think, okay, it's a solid fintech, it's recovering. But that price tag of $28.49 hides a battleground that is far more vicious and complex than a simple green percentage point suggests. The expectation here, the story that has been sold to retail investors for years, is that SoFi is just a student loan app trying to play dress-up as a bank. The narrative is that once interest rates stabilize or the student loan forgiveness drama fades, SoFi becomes just another commodity lender fighting for scraps against the big boys like JPMorgan or Bank of America. But the reality? The reality is that SoFi has effectively pulled off one of the most difficult pivots in modern financial history, transforming from a consumer app into the literal AWS of Fintech, right under Wall Street's nose. While the casual observer sees a bank, the smart money is seeing a technology infrastructure play that just happens to have a banking charter attached to it. The tension between these two identities, the consumer bank versus the B2B tech giant, is what will determine if this stock stays at $28 or pushes toward triple digits in the next decade. Let's dissect the immediate price action, because it tells a fascinating story of accumulation. We are seeing SoFi trade with a level of resilience that defies the typical high beta behavior we used to see. In the past, if the Nasdaq sneezed, SoFi caught a cold and dropped 5%. Today, at $28.49, we are seeing it hold support levels that technical analysts would have called ceilings just 6 months ago. The volume is telling too. We aren't just seeing the frantic retail swapping of shares that defined the meme stock era of 2021. We are seeing methodical, large block purchasing. This brings us to a piece of data that you won't find on the front page of Yahoo Finance, but is buried deep in the SEC filings. While some analysts, specifically from major firms like Morgan Stanley, have maintained underweight or neutral ratings, with price targets sitting embarrassingly low around $18 to $26, the institutional desks at those same banks are doing something very different. Look at the recent 13F filings. JPMorgan Chase & Co. reportedly increased their position in SoFi by a staggering 881% in a recent quarter. Let that sink in. The analysts tell you to be cautious, to wait for a pullback, effectively anchoring your expectations to the downside. Meanwhile, the institutional capital is flooding in, scooping up shares by the millions. This divergence creates a curiosity loop that you have to pay attention to. Why is the smart money buying aggressively while the smart analysis remains tepid? The answer lies in the profitability metrics that the market is finally forced to acknowledge. For years, the bear case on SoFi Invest forums was that growth is easy, profit is hard. The expectation was that SoFi would burn cash indefinitely to acquire customers. The reality today is that SoFi has just posted its third quarter 2025 revenue of $962 million, a record high, and more importantly, it is GAAP profitable. We are talking about a net income of $139 million. This isn't adjusted EBITDA trickery. This is real bottom-line income. They have achieved the Rule of 40, a SaaS metric where growth rate plus profit margin exceeds 40%, hitting a score of 67%. That is not a bank metric. That is a high-growth software metric. If you are using Schwab Intelligent Portfolios or managing your own individual brokerage account, you need to understand why they are profitable when so many other fintechs have collapsed. It comes down to the financial services productivity loop and the massive hidden engine of Galileo and Technisys. Most people know SoFi for the app, the place where you check your credit score, buy some Tesla stock, or refinance a loan. But the real jewel is the technology platform. SoFi owns Galileo, the API layer that powers other fintechs. When you use a debit card from a competitor neobank, there is a good chance SoFi is getting paid a fraction of a cent on that transaction because they own the plumbing. Then you add Technisys, the core banking platform they acquired. The Technisys integration is the reality that exceeds all expectations. The expectation was that integrating a legacy core banking would be a nightmare, a multi-year slog of bugs and glitches. The reality is, this vertical integration is now creating a cost advantage that competitors cannot match. By moving their own checking and savings accounts onto their own Technisys core, SoFi is projected to save tens of millions of dollars annually. They are no longer renting the infrastructure. They own the land, the building, and the utilities. This allows them to offer high APY on savings accounts, currently attracting billions in deposits, without destroying their margins. It is a structural advantage. While traditional banks are stuck paying licensing fees to legacy providers like Fiserv or ISF, SoFi is paying itself. Let's talk about the lending business, specifically in the context of the late 2025 macroeconomic environment. We are currently in a fascinating window where interest rates have begun to come down from their peaks. The expectation was that high rates would crush SoFi because nobody would want to refinance loans. The reality was the opposite. High rates allowed SoFi to earn massive yield on their personal loans, and because they are a bank with their own deposits, they didn't have to rely on expensive Wall Street funding. Now, as rates soften, we enter a new phase. The refinance boom is the next catalyst. As the Fed cuts rates to stimulate the economy, millions of Americans holding high-interest debt will look to refinance. SoFi is positioned at the gateway of this migration. They have the brand, the capital, and the data to cherry-pick the best borrowers. This is where the AI component comes in, not as a buzzword, but as a credit risk tool. SoFi's underwriting models have been battle-tested through a recession scare and an inflation crisis. They know who pays back their loans. When you comment on Robinhood stock trading threads about default rates, you're missing the nuance. SoFi's default rates have remained manageable because they proactively tightened standards before the trouble started. They pivoted away from lower FICO borrowers while other lenders were still chasing growth. That discipline is why they're trading at $28.49 and not $8.49. I want to pause here and take the pulse of the room, because this stock tends to polarize investors like few others. You have the die-hard believers who have held from the SPAC days, and you have the skeptics who think it's a house of cards. Comment below how many shares of SoFi Technologies you currently hold. And more importantly, are you buying this strength at $28 or are you waiting for a pullback? It is always revealing to see if the retail sentiment matches the institutional buying frenzy we are seeing in the 13Fs. Let's delve deeper into the Galileo side of the business again, because this is where the future valuation multiplier lives. If SoFi is valued as a bank, it trades at a low multiple of book value. If it is valued as a technology platform, it trades at a multiple of revenue. Right now, the market is confused. It's pricing it somewhere in the middle. But look at the client wins. Galileo isn't just serving small startups anymore. They're moving up market to enterprise clients. They're powering B2B payments. The Cyberbank Connecta launch, an AI-driven customer service agent, is a direct response to the need for automated, intelligent banking support. This isn't just a chatbot, it's a retention tool. If SoFi can sell this tech to regional banks that are desperate to digitize, the technology platform revenue could eventually eclipse the lending revenue. That is the blue sky scenario that justifies a much higher price target. However, we must address the risks, because no analysis is honest without them. The expectation of seamless growth faces the reality of regulatory scrutiny. The banking sector is under a microscope. Capital requirements are rising. Regulators are wary of fintechs that grow too fast. If SoFi faces a regulatory slapdown regarding its crypto trading relaunch or its accounting practices, the stock could re-rate lower instantly. We also have to consider the execution risk of the lending portfolio. If unemployment spikes unexpectedly in 2026, even the best underwriting models will fail. Personal loans are